Hi, everybody. It's 11 o'clock. We're going to wait a few minutes. So this is Mario. I'm the CMO of Mercurius. Together with me, there is Carlo Arbelli and Lorenzo Malanga. So I'm going to be the host of this event, and Lorenzo and Carlo will talk in the next two sessions. Let me introduce Carlo. Carlo is our Customer Success Manager. He is also a domain expert because he was a sports trader himself. And then with us is basically the person who is answering all your questions in the live chat, in the email. So probably somebody of you already met him, at least you had the chance, in via email or chat. So I would say let's get started. And Carlo, please go on.
Thank you, Mario, for the introduction. So first of all, who is Mercurius? Mercurius is an Italian fintech startup which is the aim of turning sports trading and betting into a new asset class. Why are we doing all of this? Because it has been observed that after the great financial crisis of 2008, there has been an increase in demand for market-neutral return on investment, so uncorrelated investment to financial markets. This because during the crisis, all the correlation coefficients of all different type of asset classes converged to one. So it was really difficult to protect a portfolio in a situation of a black swan event where there is a huge crisis, as we have seen also recently with the COVID situation. Why are we approaching sports betting markets? Firstly, they are quite liquid, so they are quite capitalized, and it is possible to scale them fairly goodly. Secondly, they are a prediction market like finance, so you earn a return if you are better in pricing the future. Secondly, they have got some unique features which renders them really profitable, like they are completely uncorrelated with financial markets, because what happens in a match between Liverpool and Chelsea is not affected by the macroeconomic situation in the world. They are quietly inefficient. At least they are more inefficient than financial markets because most volumes there are recreational, and they're as well decentralized. You have different markets, different bookmakers, betting brokers, etc. So this gives them a lower efficiency than centralized financial markets. And as well, in most countries, they are tax-free, which is quite important as well. Okay. How do we profit and tackle sports betting market? We build artificial intelligence technology in order to tackle them using an approach which is called quantitative fundamental value betting. What is quantitative fundamental value betting? It means that we take data, compute our fair odds for the future outcomes of a sporting event. In our case, is football at the moment, but maybe in the future will be more. And we compare our fair odds with the odds offered by the market. And if the market is mispriced in our favor, we bet on them. In example, imagine there is a match between Liverpool and Manchester City. Our fair odds say that the probability for a Liverpool win, the odds should be at 2, and the market is offering them at 2.50, we are going to bet on it. Which are the data we are using? The data are provided by our partner firm Wisecout, which is one of the 3 leading companies in football data providing. And we analyze around 200,000 data points per match. Why so many data points? because Wisecout tracks each movement done by the ball. So for each movement done by the ball, you have a lot of labels, like the angle of the ball movement, the timestamp, the starting position, and the ending position, so you can infer the speed. You have also the player who made that particular ball movement, which type of ball movement was it, if it was a cross, a pass, or a shot, and the outcome. So we have this big data to analyze and infer things from them. Our artificial intelligence, how does it work? It is comprised of 3 main modules. First, we have a core module which ingests this data from Wisecout, and from them it computes rating and forecasting probabilities for future match outcomes. Then there is the second module, which is the trading module, which takes in input the output from Core AI, so the fair odds and the team ratings, and the market feeds, which for trader is Betfair Exchange, but could be another market feed. And by combining those 2 input, it generates profitable trading strategies. Last but not least, there is the execution module, which actually translates these strategies in the market by managing betting orders and all the trading activities. How can you utilize and capitalize on our technology? At the moment, for customers, it's available through Tradr. Tradr is a web app, so you don't need to install anything. It is a value betting bot that you connect to your Betfair Exchange, and it automatically executes our strategies. It's really easy to set up. You decide how much bankroll you want Tradr to trade. You decide which strategy you want to use between our selection. Then you connect it to your Betfair account, and from there it's completely automated. We released the Tradr in January 2019. As today, it has returned a compounded return of 17%, considering just the lowest odds got between our customers. So we already took in account Betfair commissions and eventual slippage. And as well, in 2020, we have started developing other solution for a more business-to-business oriented type of customers, like hedge funds, asset managers, insurance companies, investment banks, and private equities. The team behind Mercurius is comprised of 2 main branches: sales and marketing, which is the one responsible of marketing the product, which I'm a part of, and Mario as well. And the second branch, the second team, which is the most important, is the research and development, which is the one in charge of researching the model, building the AI, and actually building the software, which is achieved by Lorenzo, who is going to speak next. Thanks a lot, and I think that Mario, you can introduce Lorenzo.
Sure. Thank you very much, Carlo, for the kind and very thorough explanation of what Tradr is. I see that we reached a few more attendees at the event. It's good. I hope that, if some of you join the event a bit later on, there is going to be also we are recording the event, so you can also replay it afterwards. So in case you missed the first part, don't worry. We are gonna send you the link to review it, and so it's going to be easy for you also to follow. Then good, perfect. I see that Lorenzo is getting ready. And as already mentioned before, Lorenzo is actually my co-founder. We met several years ago, and I have to be honest. At first, I thought he was crazy, And then I realized it was simply much smarter than myself. And so he is the head of trading and the chief data officer, data science officer, and he's going to walk you through our next strategy. Thank you very much for taking over.
Good. Thank you, Mario and Carlo, for the kind introduction. Just to repeat myself, I'm co-founder and chief data officer and head of trading at Mercurius. My background is in physics, engineering, and applied mathematics, and I've been applying so-called modern data science techniques to algorithm tradings and modeling sports for almost 7 years. Today, I will take the time to tell you a bit more about synthesis and synthesis extended, which are our latest strategies. And this will also be the chance to show you a little bit how we craft algorithms and how our R&D, research and development department works behind the hood, let's say. So I thought there couldn't be a better way of starting this talk and presentation, but with a fancy colored formula, right? So this is actually the formula that lays the foundation of our mission, because as Carlo and Mario were saying, our mission is to turn sports trading into a viable asset class. So actually to do so, we must find a positive expected return on every single operation that we make. And this is the beautiful formula, right? As for those of you who are not, let's say, technical, it is a formula that links, let's say, the market prices on future event. For example, the game about Liverpool and Manchester City, Carlo was mentioning, and our model forecast, which are a function of, again, the game which is going to play, but also, and most importantly, by the data that we gathered so far that are relevant to forecast that event. So here you have all the pieces of the puzzle. Our work is to work in such a way that every operation that we make has this value, which is strictly greater than 0. This guarantees us to achieve long-term consistent profit. But it also hides some, let's say, subtle aspects, which is the fact that this is not static at all. We have, again, new games are being played over time, which means new data is being generated, but also the game itself changes, different game dynamics, and also the market updates its belief on the game. So we really are in a fast-moving environment, competitive environment, and therefore we must continuously adapt our models, our intelligence, in order to keep our edge over time and possibly improve it. So just to remind you a little bit, what are the main building blocks? As Carlo already presented, we start from Y-Scout data. We collect around 200,000 data points per game. We crunch the data in our first module, and which outputs probabilities. Again, there is another stage we call the trading AI stage, which actually takes as input the fair odds, the probabilities that the first module generates, but also tries to handle uncertainty and also the market, how the market is pricing a given event. So since we are not working in, let's say, easy environment where it's easy to define probabilities. For example, the usual example of a fair coin which is being tossed. Of course, we can analytically know that if the coin is fair, then the probability is 50%. But in soccer, it's really hard to define in a right way which is the right probability, even with insight. So actually, the second stage tries to capture the probabilities, the uncertainty, but also how much the market is efficient with respect to those results. Last but not the least, we put down these trading signals in the market by executing orders to maximize the expected value I was mentioning before. So we were saying that we need to continuously improve, and this means we need to have a sort of iterative product cycle whereby we continuously, crunch those 200,000 data points per game. We combine them in different ways, different angles. We feed them into different models. We train them, we validate them. So there is continuously this kind of trial and error procedure, which is really like how the scientific method works. And also by paying attention to the computational side, whereby we are guaranteed that our models are fast enough to be deployed in production. But every now and then, just like every scientific good process, there is the so-called breakthrough moment, a eureka moment, right? Where you have find some, let's say, improvements that are significantly better than the state of the art of the existing algorithms, right? So this is what actually happened some time ago. But then again, we proud ourselves of being obsessed by numbers. So we need a way to scientifically, objectively measuring these improvement, these breakthrough, right? So we defined two different set of metrics, because here we are sitting on the fence of two sectors. On one side, we are trying to study, describing the beautiful game. So we need to quantify how good we are at classifying soccer results. And for those, we use some classical metrics, which are the hour under the curve, the rank probability score, the cross entropy, something we feel are the right metrics for the problem at hand. But on the other side, it's not sufficient to improve those metrics, because, as I was saying before, we are acting in a competitive landscape. So at the end of the day, it's not about being right, it's about making money. So we need a way to measure how good we are at making money. And this metric, which we borrowed by quantitative finance, especially it's used by hedge fund, it's the so-called return over maximum drawdown, which is the annualized return divided by the maximum drawdown, which is the maximum loss you could experience in a betting year. Then you might ask, okay, what did you improve in those strategies, since we have those two dimensions whereby you can improve the existing algorithms? Well, of course, we reduced the error, the predictive error, which we attribute to bias. I will explain a little bit later what I mean by bias, on every single prediction, which means that we are 1% more accurate in forecasting future events. It might sound a small improvement, but if you think you can compound this small difference on a large amount of events, then you obtain a huge result. We also managed to improve our target return over maximum drawdown by a factor of 8%, which means that with the same level of risk, you are expected to return 8% more. Last but not the least, we managed to improve the turnover, which is the amount of operations we are able to spot in the market, by a factor of more than 100%, which means we are able to spot more than double the value bets than before. And bear in mind, we didn't compromise on quality. We just have higher quality, but with also a higher quantity. So we must see now how those improvements translate into actionable numbers. So these are the results and the pairwise comparison of the backtest strategies. So first, you can see PhoeniXG, so the previous conservative strategies comparing to synthesized, and we see that the absolute returns, the annualized return, improved massively, but mainly that the number of bets has more than doubled. On the other side, on the more aggressive strategies, we see again that the return metrics have improved, that also the number of bets have improved, and also that the ROMAD has a really nicer profile. If you allow me to just go a little bit deeper on the main improvements, we see again that the number of bets has improved dramatically, that the average odd has been lowered. And this is really important because it reminds us the fact that we are going to place less risky operations, right? We are going to hit more often the right result, as we can see in the strike rate row. So, but at the end of the day, what it really matters is the return over maximum drawdown, which is now 1.13 for the synthetic strategies and 1.1 for the extended strategy. Now, the question could be, but how did we manage to obtain those results? How did we achieve those results? Well, we had two dimensions whereby we could act. On one side, we just had to improve the model. It sounds trivial, simple, but it's not an easy task. On the other side, we could adapt our models to a different market, a market which has lower intrinsic volatility. So let me start from the first one. And what we managed to do was improve our models by combining the existing models that we already have. And this is a technique called ensemble modeling. In order to understand how this can work, let me just make a simple digression on what is modeling, right? Modeling is actually learning a function that maps some variable, something we think are good predictors to a response to a target variable. So let me make a simple example, which is quite famous. Let's try to predict the price of a house according to its size. Well, we have some data, which are the red crosses on the plot. And also what we need to do is to find that blue function. And we may find different algorithms to learn this function. But what it really matters to the data scientist is to obtain the middle spot, right? The one which is just right, because all practitioners know that there are two sources of error. One lies in the so-called bias. So let's say the simplistic assumption that you make to, let's say, represent the real world in a simplified way. And this allows generally to obtain models which are really robust, which are really good on unseen data, because at the end of the day, you are not going to predict something you already know. You need to predict the price of a house you didn't observe before, right? So actually having a high bias kind of gives you, let's say, the possibility of generalizing a little bit better. On the other side of the spectrum, there is actually the nightmare of every data scientist, which is a model which features a high variance, which means a big overfit. So basically, your learning algorithms just goes through the training examples that you feed him, but every time it will be shown an extra observation, it won't be actually good at predicting any of it, right? So in Mercurius and in this, let's say, framework where we model soccer, we pay a lot of attention in reducing the overfitting risk, because we are, again, forecasting future results. So we really need to maximize for out of sample, let's say, predictive accuracy. On the other side, this comes with the cost of often having models that make strong assumptions. So we needed a way to reduce this source of error, this first source of error, which is due to bias. Now, another example is that a model works like a pixel, is a way, let's say, a convenient way of representing reality, a complex phenomenon, in an easy, convenient way. And we all know how important and good our pixels are, approximating real world, right? But then you could have pixels of different size, different shapes, different sensitivity to different color grades, right? So models are like pixels, are ways of representing the real world. So every one of them might have different characteristics, different data that are trained on, but also, and more importantly, a different mathematical structure. What you obtain if you combine the right pixel in size and shape is that you have a better image, right? So with models works the same. So what we did was trying to merge and combine our two pixel classes. So we have currently two model classes, which are trained on similar data and share similar, let's say, data points, but they also have a slightly different mathematical structures that allows them to focus on different angles. On one side, we have a model which is really focused on modeling, let's say, the ability to generate and block chances. Therefore, it kind of assigns big penalties whenever it observes a result which is not really reflected by the chances that the two teams involved generated. And it has let's say, stronger dependence on the most recent form of the teams. On the other side, we have a model which actually is more focused on measuring the relative differences in skills of the team and how those evolve over time. It tends to assign a smaller penalties of over or underperformance because it tries to attribute the observed results to some sort of latent ability. Last but not the least, it is since it let's say, models the evolution of the skills in a structured way, is more dependent on the long-term form of the teams and the players involved in a given team. But then our goal was to combine those two classes and obtain a reduction of the overall predictive error. And from these plots, we knew it worked because here we have two different classes of metrics. As I was saying before, we use the area under the curve, which is the, let's say, top metric, which says that the closer the better is our classifier, the closer this measure should be to 100. Whereas we have the other two metrics, which are to be read in the other way around. So the lower, the better. As we can see, in all the three metrics, we see the same pattern, which actually looks really robust. So we have two separate models at the extreme of the spectrum. So when you see 1 and 2, those are the single models. And we already see that there is always one model which is better than the other. But again, given also the nice shape of this intermediate curve, which show how mixed those models are and, let's say, how much weight one has over the other, we found that there is a global optimum, which is the maximum here in the area under the curve, which and which is a minimum in the rank probability score or in the cross entropy metrics. The really fancy stuff to notice is that the optimal mixing parameter is really coherent among the three metrics. So actually, we already know that the combination of these models is always superior of the single instances of the model. Now, let's take a breath. If you remember, we had two areas of action which contributed to improve our strategy. And we just went through, let's say, the first point, which is boosting predictive accuracy by using ensemble modeling, by combining models. Now, I'm going to tell you briefly how the second point, which is the adaptation of our algorithms to a stabler, less volatile market, improved our strategy. For those of you that are not familiar with betting and Asian handicap, let me just make a quick explanation of what we are talking about. When we speak about Asian handicap, we are actually shifting the problem of modeling what is the probability of a team winning, rather to what is the expected difference in goals between the team that should even out the odds. So just let me make a simple example. We already know that Juventus is much stronger than Benevento, right? So if you had to place a bet on Juventus, of course the odds will be really low. But if we add a virtual 2 goals deficit to Juventus, which means that Juventus, to win the game with the handicap, needs to win by a 3-goal margin, then the odds will shift towards even money, so towards 2 odds on a given side. And this is as a really nice implication, because first, for this reason, the reason is being the fact that we already work with 2 odds range, makes this more attractive for professional bettors, meaning that the market tends to offer better liquidity on those bets. Since in some sense we are removing the concept of a draw, by the Asian handicap, actually we are also witnessing and experiencing lower betting margins, which are a really cool stuff to observe. And most importantly, even if the team that you backed is going to be defeated, if you placed with the right handicap, you can still win your bet. And here I placed an example of assigning a 1.5 handicap to the underdog team. And as you can see from the green, let's say, rectangles, there are a lot of more results that allow us to win the bet. Of course, there is no lunch for free. This more probability is, of course, linked to lower odds. But to sum up, we will have lower odds and hence lower payouts. But of course, also a higher win rate with less drawdown, and also the mitigation of drawdowns given by the fact that some of the bets might be partially refunded or fully refunded by the structure of the market. In the end, we also face less operational risk because I was saying before, better liquidity and lower margins. So now that I walked you through the action that we made, let me spend a couple of words on the fact that we decided to keep two different risk profiles. As a company, we are committed to satisfy our customer needs. Therefore, we produced and we kept maintaining two strategies that are featured by two different risk profiles. So whereas in finance, you might be, let's say, accustomed to the fact that a portfolio risk is usually characterized by the asset classes that compose it, here, the differences lies in the criterion which is used to select if a value bet is to be fired or not. So in the synthesis, in the conservative profile, we have optimized let's say a trading layer with the goal of maximizing ROMAD, which is the return over maximum drawdown. So this tries to achieve the highest returns possible by reducing the effect of drawdowns. On the, let's say, complementary in the aggressive profile, what we did is to keep the maximization criterion focused on the return over maximum drawdown, but we also the possibility of having, let's say, a bigger reward if the strategies allows for a greater return. So actually here we are trading a little bit of consistency or a little bit of uncertainty for greater absolute returns. And here you can see a comparison of the main financial KPIs that we backtested. And as you can see, of course, the more aggressive profile features a greater return, a greater volatility, also, and most importantly, a greater amount of bets, because this is actually the real difference. The fact that the aggressive profile places a bit more of operation that feature a positive expected value. What's worth mentioning is also the fact that the conservative profile has a lower average odd, which is lower than 3, whereas the aggressive profile is a little bit shifted in a high range, which is 3.2. And as a consequence, you can see that the strike rate move accordingly. At the end of the day, this is, I think, the most convenient way of showing the differences between the two strategies. So we have some markets where all of them act, and actually all the bets that Synthesis places are placed again by Synthesis Extended, but Synthesis Extended, as the name suggests, places a few more bets, as you can see in the, let's say, orange tiles that are colored. So in order to sum up really in a couple of points, in a nutshell, what characterizes those strategies, we have that Synthesis is more robust, is a little bit more focused on the Asian handicap, and really tries to diminish the impact of drawdowns. On the other side, we have Synthesis Extended, which looks for greater turnover, which means, of course, looking for greater expected value in the market, and basically trades more uncertainty for more absolute returns. in practical terms, it will mean it will have around 80 to 100 1x2 bets per year with respect to the synthesis strategy. This is quite intuitive because the 1x2 market have, let's say, wildly more volatile odds range, and therefore they also hide some sort of more upside potential, whereas the Asian handicap tries to maximize, let's say, the growth rate and its stability over time. So, hoping to have been covered all the relevant points of our release, I will now let the Q&A session start.
So, thank you very much, Lorenzo. So we have also Carlo back. Carlo, can you hear us?
Yes.
Good,
Yes.
good.
I hope that you hear me well.
Thank you very much, Lorenzo. I think you cover a lot of points. We received a few questions, and I'm going to address now the question to you both guys. Probably there are some more for Lorenzo, some more for Carlo. I would start from one of the question that Matthew posted. It is regarding the Asian handicap markets. He was asking if it's only looking at Asian handicap. I think you already answered this question during the presentation, but just to be sure, if you want to go back, I mean, he did the question very early in the webinar, so probably it's fine. But I think that it was clear. But if you want to go back to the slide with the markets.
Okay.
I think
was before. Okay. The comparison.
Yeah, the comparison with the markets. No, yeah, exactly. Where was it?
No, Lorenzo, it's the one.
Lorenzo, there we go.
The leagues.
This one.
Exactly. This one. So
I think there is a little bit of lag, maybe.
Okay.
So, yes, as you can see here, we act on the normal 1x2 market and also on the Asian handicap market as well. On some market, we have enough confidence to place bets on the home side, only on a few of them on the away side, in particular in France. But yeah, we are just focused on the main 1x2 market and the Asian handicap one. Of course, there is a work in progress. We are trying to come up with total unders and also Asian totals in the foreseeable future. But for the time being, the existing strategies are just focused on those main markets.
Okay, perfect. Quickly, another quick one on still on the strategy. So is the bot limited to bet only 1% of the bankroll, or is there any unwanted exposure for the investor?
Yes, we keep this, let's say, this policy. We are not going to risk more than 1% on a given operation, but now we might have some more exposure on a single event, because we might, for example, on the Premier League, we might bet on the home team, let's say on the straight outright winner, but also back the Asian handicap line. So whenever we have a really strong confidence on both the markets, then we are gonna be double exposed on that team. So this is actually, thanks for the question, actually is really, really relevant. And so to answer briefly, yes, now we will be exposed sometimes by maximum 2% on the same event, but it won't necessarily be exactly the same bet, because the Asian handicap has a different structure.
Good. Again, on the leagues, do you expect to add more leagues and therefore more bets in the future?
Yes, we are constantly trying to improve let's say the coverage ratio of the existing leagues. Of course, since our system is adaptive, we must surrender to evidence, right? So every time we see that the new data brings us new insight on how confident we are on a given league, then we adapt to change. But of course, our goal is to have a broad coverage as much as possible, at least.
Okay. Just another question on the future. Where is it? And I've lost it. Yeah, do you plan to look into more than just Betfair, like markets, in the future to take advantage of more liquidity?
Yes, that's a really spot-on question. Maybe let me just take the slide with the modules, right? So of course here it's a matter of having enough, let's say, liquidity points in the market. And of course, we have already been integrating other betting brokers, which kind of allows for a more centralized liquidity management. So of course, this is quite priority, and we are already working on it to integrate more and more liquidity platforms.
I think that there is another question that is related to this one, and is more on how we're going to manage the liquidity in the future. And where is it? As you start manage more funds, how do you deal with liquidity or lack of when it comes to locking in the best identifying odds?
Of course, that's a question which is relevant to everyone that has an edge on the market and wants to scale it with volumes. We will, of course, focus on more liquid competitions whereby the limits are much higher. But as soon as we smash them, of course, we have no other option than splitting orders, trying to maximize, let's say, and sophisticate the execution layer. And also, I think there is no other way around than modeling extra leagues, extra markets, extra sports. So if we are going to saturate completely soccer, and that will be actually an outstanding result because it means that we are actually superior than the entire market, then we will move to the next sports, for example, basketball and American sports. So I don't think there is a more clever answer to the fact that at a given point in time, liquidity is not infinite. We might concentrate and focus on the ones that are more liquid. We know that we can place huge orders on, for example, the English Premier League. And so we will always prioritize the most liquid competitions. But if this quantity is, since it's limited, is not infinite, we cannot create it from nowhere, right? So we just need to shift to different markets or spread orders or model different markets which are, let's say, equivalent to the ones that we are trying to place bets on.
Okay, now a question for Carlo. This is actually the most voted one. Basically, the Matthew is asking if we are still. So I read it. I remember reading on the website that with other trading strategies, you prioritize those clients with larger bankrolls. Everyone gets a chance to get money on, but you will tend to lean more towards the bigger players in your portfolio getting money on. And he asked if we can share an idea, an aggregate data of the size of the bankroll of clients.
Okay.
Top 1% or something. Yeah.
Okay. So
average.
At the moment, the difference circa between the customer who got the most bets and the one who got the less number of bets is around 25, 30 bets. This doesn't impact the expectation of the profits, because if the bet doesn't have positive expected value, we don't place it, but impact the speed in converging to the yearly expected returns. So at the moment, it is not yet a problem. And also, it's not that we prioritize completely huge bankrolls. It's a little bit more sophisticated than this. We prioritize them, but we are clustering execution. So we have this iceberg algorithm, which split orders and create these dynamic clusters where you have like a big customers and few smaller ones which go together and split orders. So at the moment, it's quite handled, but will be improved. About the distribution of the bankers we handle, it's obviously heavily asymmetric. You have a few customers with big bankers like 100K, 50K, and more, and you have a lot of customers with small bankers of $1,000. Okay, the typical customer journey until now has been they started with 1,000. After 1 year, 1 year and a half, they increased to 5,000, 10,000, or even more. So at the moment, this is how it is. But since now we are also finding ways to access betting brokerages, which can accommodate bigger customers. At the moment, this is not yet, fortunately, a problem. Probably will be in the future, and obviously we are constantly researching and developing our product markets, infrastructures, in order to manage to accommodate everyone. Also, because for us, because more we place, more we profit in that sense.
Yeah, this is also just let me highlight this exactly. We are also trying to go with Asian brokers for some clients, and this will open up completely different liquidity. Of course, it's not going to be accessible for everybody, but just for the top clients and for the B2B clients. Here it comes the question of Matthew again. I don't know, Lorenzo, if you want to answer it, or I will do it. But the question is if we can tell a bit more about what are we planning for the B2B, and if you can give some more ideas on because some of them may be interested.
Maybe I say something. If you want, feel free to add if I forgot to mention some relevant aspect. Well, of course, we have been receiving the interest of, let's say, adjacent players, so fans of different sizes and different players in the industry. So we are trying to build this, let's say, modular API whereby different market players can create their own offering on top of this market intelligence. So, for example, it could be, I don't know, insurance companies that want to price the probable end of a given team at the end of the season, what is ranking, or for example, a football player agency that wants to access forecast about which player will be the most valuable in 5 years. I'm just making random examples here, but as you can see, there is a big demand on, let's say, data intelligence on sports, which can be capitalized to create financial products. So
the question was also a bit more concrete, asking, okay, could this involve an export of probabilities for the core AI, for example?
Sure, definitely. It could be a way of, setting up the product depending on the requirements of the counterpart. So definitely, we are working again on this modular API, so we can meet the let's say more also tailored questions and requirements of these more sophisticated clients.
Yeah, exactly. I mean, we are working with an asset manager that is interested in this product. And for example, with them, we are developing certain custom models for them, that there are sub models of the three main models that we presented. Just a quick thing on the core AI. Yes, it's definitely something we can do. Honestly, we have never managed to do it, because at the end the problem is how to find the right agreement, because but it's just a commercial side, honestly. But they can definitely do it, and it's on our schedule. I think we are almost out of time. I think that there was so I
can keep going, there are a lot of other questions.
I hope this is not going to break the webinar again. I think let's see. There are two questions with two votes. One is the new rock of synthesis extended is 44%. And based on, so what is the estimate of the rock less any fees paid to Mercurius? Maybe Carlo, you can answer. I can also explain a little bit how our fee structure works, because we have no.
It's really, Leon, it's really easy to compute the estimate. You simply get rid of 30% of those yearly returns, which is our performance fee, and then you subtract 2%, which is the typical management fee our customers pay. So for the ones of you who are not yet familiar with our fee structure, getting it simply without all the niche scenarios, it's a 30% performance fee billed quarterly with a high watermark in place, so you don't get billed on non-existent profit, and a yearly management fee of 2%. So Leon, by getting rid of those, the expected yearly return net of our fees is around, I made just the computation, is around 31%, 32% yearly returns. So that it is. And,
Carlo, we cannot hear you anymore. Let's hope that the cast is not going to be interrupted again. Yeah. So this one,
because of this one regarding COVID.
Yeah. Let's go for that. So of course there is a lot of uncertainty in the world because of COVID. So Leon is asking, do you account for the loss of crowd advantage in certain games, or do you not see any significant variable played by the COVID, and what is the COVID effect in general, I would say?
Yeah, that's of course a smart question. Actually, pretty hard to answer, because actually it's still an ongoing process. So actually, we measured some big differences in the end of the 1920 season. The first one being quite big and self-evident, which are the fact that the schedule was really different. So different with respect to before. So you had like for 3-4 months, games played every 2-3 days, so on a continuous basis, and this was actually something really different than before. And the other main difference is, of course, the, let's say, absence of people in the stadiums. So the home advantage, of course, was reduced. According to our computation, it was reduced by a factor of 1/3, but again, it's a kind of tricky technical question, because we are still observing this phenomenon, right? It's still ongoing. So we made some, plans on making some retrospective analysis in a couple of months to see if those trends are confirmed. But just to answer more directly, I actually am quite proud of the fact that these changes are automatically accounted for in our models, because we model directly the home advantage, and if it is going to be squeezed in time, we are going to model that. And we also model the skill evolution of teams. So if the schedule is tighter, more challenging, so on and so forth, we are able to capture this, right? So
good. Thank you, Lorenzo. Did I interrupt you?
No. It's
okay.
Good.
Then another question on the product itself. So are we able to use our Betfair account ourselves was joined up, or would this mess up with the account? I can answer. Well, if you want, Carlo, please go.
Yes, you can still use your Betfair account as usual. Our bot doesn't interfere with your own betting in any way. It's the same, since it's through the Betfair vendor program and their API, etc. It's simply as if you are also placing our bets, but it doesn't in any matter interfere with your own activity. Like, you can keep using it as always.
So we have a tricky question, but we don't want to skip it. So was the return generated this year less than backtest average annualized return?
Yes.
Yes. The main reason is, of course, natural volatility, and so let me stress the fact that those are, of course, estimated target variables, target metrics, right? So it is a matter of having the right sample size to achieve that return. So it is perfectly possible and actually probable that different years will have different returns. As you can see in the backtest data, not every single year has had the same return. So this 44 figure is, of course, an annualized average compounded returns over the whole span of the backtest. And of course, it's always hard to make to answer this question in retrospective or with insights. The main reason to me is that, for example, China this year had a different market structure because of COVID, and one possible reason, but then again, I'm just speculating, I need evidence to make those conclusions, is that probably the different league structure played a role in making some of the forecast a little bit off with respect to our standards. So that's my take. But then again, time will tell, because we will keep placing bets on China with these new upgraded models. So my expectation is that, again, as the number of operation increases over time, we will converge to analyze the rate of return.
So Chris was asking exactly about China. The results of this year has been pretty bad. We can openly say it. And I think you already answered the question.
My take is that the different market structure played a major role. And of course, we are not talking about thousands of bets in China. We are still talking about a limited amount of operations. So let's see if also next year keeps the trend. We are confident that our model has actually a good edge on those markets. So we will see next year if there is a correction, which is something we are going to expect.
So now a question for Carlo and then one for Lorenzo. There are a couple of questions about the premium charges, of course. So will they be charged and how does it work?
I can answer it. Okay, so the premium, since our bot is working on your own account, the Betfair isn't computing the premium charges on our action as a whole. So depends on your own bankroll, and the triggers for premium charges are quite sophisticated. It's not that only if you go in profit they charge them. You have also to make a certain number of bets in a certain time, achieving a certain profit. At the moment, we can't speak for the future. At the moment, none of our customers got premium charges for our action. There are few customers which already had premium charges on their account. Obviously, they are like a Damocles sword on everyone in this industry, but by going to betting brokers, opening to other markets, as was said, maybe markets, BetDuck, Matchbook, and Pinnacle and other sharp operators, we can manage this. We are also in a partnership with Betfair by being in the Betfair vendor program. So we have got also some kind of leverage in the negotiation. We are not just the alone profitable traders. We got the premium charges. So they are a possibility, but they are not a certainty against us. So at the moment, that was not the case. And we hope that by our action in other markets and improvements and negotiations, we can avoid them, at least for our own action, for the action made through our bot.
So one question for Lorenzo, or maybe also for Carlo, actually. So when are the bets placed? Could it be days before, or does the model need to wait for team news?
We are constantly working on these to improve our execution layer. So we have different policies for different leagues. So it actually depends. Our models are not directly reactive to formation news. So we might place some bets before that, but actually most of the bets can be placed also a couple of hours before kickoff or even minutes before kickoff. In general, we do not place many days before because the market still has to form liquidity. We do not want to enter the market and give this information on our side, but we might witness some change in the future because on the Asian handicap lines, dynamics are a little bit different, and we might decide to enter the market a little bit earlier to maximize the value that we extract from the market. So the short answer is that it depends. And it depends on the league and the confidence we have on that league and the liquidity, of course, because if there is not yet enough liquidity, it doesn't make sense even to try to find orders, and makes sense just to wait a little bit.
Indeed, is something that we are now working on right now, because we have observed that on a lot of the Asian handicap lines, because before you have to understand that all our backtests are run against pinnacle closing odds because they are considered the most difficult to beat and the most efficient. So what happened is that for the Asian handicap, we are observing that we are tending to bet on lines that are lower and down. So if we can increase the time span we use to bet on and improve that type of analysis, we can extract much more profit from them, more than the home draw away market.
Correct.
Perfect. Meanwhile, I ask you another question. Can you go back to the top of the presentation, because Shop is asking how can we monitor the returns? What is the commitment in terms of amounts and time invested? Maybe you can present the slide with the 3 steps where there is the dashboard and explain. I can explain it myself, or Carlo, if you want, go on.
But everything is really simple. So you will get the bot will be connected to your Betfair account, and obviously you can check within your Betfair account the profit and loss made by the bets of our bot since they placed them. But also you'll get a dashboard, which you see that sort of screenshot, which will collect all the bets done on your Betfair account by just our bot, and keep track of them, recording them already of net Betfair commissions, etc. So you can keep easily track of everything. Which was the other part of the question?
What is the minimum
bankroll?
Bankroll, yeah.
The minimum bankroll is the equivalent of 1,000 British pound sterling. So if you are in euro, is like 1,100.
And also, what is the time that they need to dedicate to it?
Since it's completely automated, so you personally don't have to dedicate any time. The time the portfolio needs to convert it to expectation is on a yearly basis, because and now maybe slightly less, because with the Asian handicap we lower down a lot of the volatility, but still you need a lot of operation to reach a certain p-value, so a confidence, like the law of large numbers, to have enough operations to convert to the expectancy. So given the experience, as you have seen from our performance, that is recorded at the worst odds we got between our users. So it's like the most robust estimate, as you can see, from 2019 to today, which is like 1 year and 9 months, is a 17% return. So I think like 1 year and a half is like a robust estimate of time in order to converge to the expectation. It's a yearly product. It's more like an ETF in finance. It's not like arbitrage betting, matched betting, or this type of practices you can find in the market.
So, as you mentioned, ETFs, there are a couple of questions regarding the B2B, and basically asking how, when, where they'll find out about the B2B, how it works, because Matteo and Matthew are asking similar questions. I would simply say that if you're interested in understanding more about the B2B, let's get in touch directly. Let's have a chat. It's the simplest thing to do. Just let me say that we expect to work with companies as it's a B2B, and everything can be tailored. It's not directly a financial product we are gonna create, because we cannot create financial products, and it's not in our interest. It's our interest to create a technology that is supporting companies to create financial products, or other forms of products they want to create. But let's get in touch, and let's discuss it over a Skype call or a Meet Hangout. I would say that yes, the webinar has been recorded. I hope so, actually, and I hope that we'll be able to send you guys the video so you can see it from the beginning later on. I think the last question was related to different sports. Can we do this on tennis and cricket?
Yeah, just to give you a little bit of an overview of the long-term plans. Actually, even during the COVID crisis, we explored some alternatives to model, let's say, sooner than planned. And actually, our focus will be more on American sports in the next year, starting from probably the second half of 2021, focusing on basketball and possibly also American football. Then it will come tennis and cricket as a ladder, let's say. But of course, we will focus on most liquid and also most robust in terms of industry, and also, let's say, COVID-proof. Since this year only, actually, the NBA proved to be the only organization to be truly COVID-free. Then our guess is that those strong organizations will be a better choice for us to model.
Good. Thank you very much, guys. I think we actually answered all the questions. I'm very happy there were so many questions. I think it helped a lot to dig deeper into our company, what we do, and our plans for the future. Thank you, everybody, for joining the webinar.